we are no closer, perhaps, to understanding exactly where the trade arrangement lies in the future, are we?
Unfortunately, probably not. I think, in a sense, we've had this period where the two sides have been talking at each other for a prolonged period without necessarily resolving any of those differences in the negotiation stance. And, of course, what we've got to remember is that we're talking about this two-year exit period, or at least into the implementation period, which, that time-sensitive nature does put an increasing onus on the UK to try and resolve the scenario and resolve it correctly. But, of course, as far as industry is concerned, there are obviously issues in play because, of course, contingency measures need to be enacted. And the longer this process of division, or the inability to create a coherent strategy, then the greater the risk is that markets will become frustrated with the UK outlook. And, of course, that also has implications for monetary policy, where markets have been quite happy to discount a rate hike from the Bank of England as early as May. I think in the context of the relative benign nature of the labour market, but also the pressure on the consumer, which I thought was one of the interesting points of that revision in Q4 GDP yesterday, suggests to me that sterling still has a degree of vulnerability about it.
Yeah, that's interesting. I mean, the chances of a rate hike in May have gone up this month, haven't they? From, 51%, I think, at the start of the month, up to 83% the markets are pricing in a rate hike in May. So the market is coming round to that thinking. Are you then bullish on the pound or pessimistic about the pound? And I'm asking this, you can talk about any cross you like, Jeremy, but I read some research from Crédit Agricole that was talking about how the Swiss franc is going to be a laggard in terms of central bank tightening of policy. And so they are quite bullish on the pound versus the Swiss franc, for example. How would you play the pound?
Well, I think you have to look at the time parameters in the first instance. I would agree in terms of the context of the policy debate in terms of Switzerland, absolutely. But in the context of the UK, I think you need to be mindful of the time parameters because, of course, if we are going to get any deal agreed, however outline or heads of terms, I think it will be very much a case towards the end of the profile of the time horizon. So if the European Union are talking about wanting to get something in place by October, then I think it will probably be only about October that any sort of outline agreement will start to be formed. But I think up to then, I think there is a degree of political vulnerability in sterling. I think the market is mispricing or overpricing the probability of the Bank of England hiking in May as well. Because, as I say, going back to that Q4 GDP, if you look at the consumer spending element over the course of the last 5 quarters and compare that with the previous 5, i.e. pre-Brexit, that consumer expenditure has dropped by around 0.5% per quarter. That's underlining the pressure on the consumer sector. And I think we shouldn't underestimate that. So I think the political risks, I think the overplaying of the rate expectations in the UK does leave sterling vulnerable for probably the next 3 to 6 months. And it's only as we get towards the autumn that we may see a degree of political pragmatism which would encourage something of a better degree of fortunes for sterling at that time.